I'm Greg Hunter. Welcome to USAWatchdog.com. Well, this is a real treat. We haven't had him on in a while. He's a best-selling author. He, of course, did this book. Anybody that buys one of his books, it's kind of a giveaway, David Stockman, it gets their money's worth. I mean, this is 700 and some odd pages. I mean, when you look at this, this is Trump. This is another 500 and some odd pages. His latest book, I don't even have the book to. It's coming out in the book form on the 20th, but you can buy it now on e-form. It is Peak Trump. It's David Stockman, The Undrainable Swamp and the Fantasy of MAGA. David Stockman, thanks for joining us today on USAWatchdog.com.
Very happy to be with you, Greg.
Whether you can't, I mean, this is another book. If you on the ebook on the PDF that was sent to me because it's so new, you can get it. You can buy it now, and you can get it in e-form, but it'll be in bookstores on the 20th as well. But you can get it right now. There'll be links for that in the after the interview section. But I wanted to start with the Fed is the mortal enemy of MAGA. The Fed is one of your chapters. You go into this a great deal. And might I say, too, really well done. Lots of charts and graphs and information and sourcing and a huge book. Bravo. But let's start with that. The Fed is the mortal enemy of MAGA. What do you mean by that?
Well, first, I mean that, unfortunately, Donald Trump doesn't understand it. He is, actually bashing the Fed intensely in recent weeks because it's trying to normalize policy. But my argument in the book is that it's the very policies that Trump wants to continue at the Fed that have caused all the problems for our economy and that caused flyover America to essentially lose its place in the economy and actually and ironically was the force behind Trump's election. He ran on two things. The Main Street economy is failing, and that's true. The median real income, as I point out in my book, for households in America has not increased since the year 2000. And despite all the ballyhoo that we've had about, the Fed rescuing the economy and that we've now had this 8 or 9 year long expansion, real household income is still flat. Or if you look at industrial production, for instance, you go back to the pre-crisis peak, compare it to today, and it's up 2 or 3%. Now, by contrast, if you look at the NASDAQ 100, which is really a proxy for the stock market and especially for the leading edge technology sector, it's up 200% in inflation adjusted terms. Now, the reason Trump won is that Main Street got nothing or 3% and Wall Street got 200%. And the reason for that is the Fed. First, because these massive, money printing campaign never got out of the canyons of Wall Street, as I call it. It didn't help the middle class economy. It didn't generate new business investment. It didn't, caused significant increases in, let's say, housing construction or mortgage lending levels. It never really left the canyons of Wall Street. It became a huge source of speculation, as I call it in the book, free carry trade money. I mean, when you have 8 years of interest rates nearly at zero in nominal terms and actually negative in real terms after inflation, that's the mother's milk of speculation. Wall Street loved it because you could buy anything with a yield or anything that might be appreciating on leverage, pay overnight leverage or short-term, funding, pay essentially zero for it, harvest the yield on your asset or the gain, and, laugh all the way to the bank. So that's what Fed policy did. At the same time, they keep insisting that 2% inflation is some sacrosanct goal that we must achieve, and I call it 2.00%. They're so precise about it that it's really kind of ludicrous. But the argument is that this is a proxy for economic health. My book shows that it's the problem. It's the fundamental reason why jobs have been offshored, why we've lost tens of millions of middle-class jobs, why we have an $800 billion trade deficit that Trump appropriately identified and campaigned on. But, it's not because of bad trade deals or stupid people at the Commerce Department or USTA or the State Department who negotiated dumb deals, as Trump says, but it's because the Fed inflated the domestic economy year after year, drove up costs, prices, and wages at 2% come hell or high water. You do that for 2 or 3 decades, and all of a sudden, you're totally uncompetitive. You have the highest cost structure in the world economy, and the jobs migrate and production migrates to where capitalist companies can find lower costs and better profits. So the Fed basically hit the economy and the middle class, what I call flyover America, with a double whammy. Its 2% inflation drove jobs offshore and undermined wages in the middle class economy. At the same time, it vastly inflated and subsidized a massive gambling spree and financial asset inflation on Wall Street. And so we end up with the worst of both worlds. And I point this out in the book, and I think it's important that not only is this policy what I call the enemy of MAGA, Fed, the enemy of MAGA, had the untoward consequences I've just described, but it's also caused a artificial and dangerous distortion in the allocation or the distribution of national wealth. If we go back to 1987, when this whole policy really got going under Greenspan, when he panicked at the time of the great Black Monday 22% stock market meltdown.
87.
If we go back to that point, the top 1% of households roughly own 34% of the net worth in the American economy. The bottom 90% owned 34%. Now, I'm not complaining about that. I'm not an egalitarian. I think capitalism rewards people who contribute, who innovate, who take risks, etc. So there was nothing wrong with 90% having a third and the top 1% having a third. But in the last 30 years, and this really can't be emphasized enough, that distribution has gone to, hell in a handbasket. The top 1% now own 40% of the national wealth, and the bottom 90% of U.S. households, all those people that live out in Wisconsin, Michigan, Ohio, Western Pennsylvania, Iowa, the places that elected Donald Trump, now only own 20% of the wealth. So you went from even Steven to 2-to-1 wealth distribution between the top 1% and the bottom 90%. The people are not happy with that outcome. They might not be able to articulate the exact statistics or figures that I've just cited, but they know there's something wrong. They can see there's enormous prosperity on Wall Street and among what I call the bi-coastal elites, and they can see, by contrast, the stagnation and the actual retrogression in the economy that's occurred in great stretches of flyover America or Main Street. So until you take on the fundamentally wrong-headed Keynesian policy at the Fed and let interest rates find their own level and get out of the stock propping or price-keeping business, as I call it, the so-called Greenspan, Bernanke, Yellen, Powell put, until we let capitalism and free markets function in the financial system, which is the heart of a capitalist economy, we're going to have the terrible results that led to the outcome of the 2016 election. Now, frankly, Trump is responding to those symptoms, but he doesn't understand the problem, how we got here, and he thinks if he puts big tariffs on the middle-class economy, they're going to pay the price for this 10% tariff, or if it goes up to 25%, it'll be even worse. And that's not going to solve the problem. It's just going to cause a global trade war that will actually set things back. He needs to focus on the Fed, and he needs to clean house and get the Keynesians out of there. I'm happy that he's attacking Powell, but from the wrong side of the spectrum. He's attacking Powell because from an easy money point of view, when actually we should be attacking the Fed for the disaster that it's caused in the American economy.
We're never paying any of this money back. I mean, Nomi Prinz came on not long ago, and other people have done this, quoted the same number. We were roughly 60 trillion in 2008 in debt, in global debt, and now we're up close to 250 trillion. Well, I mean, we're never paying this back. Isn't there going to be a big default? Maybe if it comes from, the Italian banking crisis, or it comes from somewhere in the world. Aren't we going to, isn't the world going to have a big haircut, a big write down of debt?
Yes, I think that's very likely, and why it's so dangerous.
Explain.
It's so dangerous to be in the stock market today, because the whole thing is propped up by debt. And as soon as the defaults begin to, cascade through the system, there's going to be a tremendous correction. Now, I want to address exactly the question you raised, because it is true that debt has just exploded in the global economy. Not only 180 billion prior to the crisis in 2008, and now it's 250 trillion.
180 is 160. 160
I meant trillion, not
160
billion.
trillion.
Yeah.
Around 165, somewhere in that word. So yeah.
But the more important thing is, if you go back to about 1998, and that was right before, the long-term capital crisis and that particular go-around. Go back to the mid-late 1990s, there was only about 40 trillion of debt in the world.
Wow.
Public and private, all companies. Now there's 250 trillion. So the question is, how did it happen, and what is going to trigger a cascade of defaults that we've been talking about? The answer is, at the same time that this debt was exploding from 40 trillion to 250 trillion over basically a 2-decade period, the balance sheets of the central banks of the world went from 2 trillion to 25 trillion.
Oh.
In other words, if you take not just the Fed, which during that period went from about 400 billion to 4.5 trillion, if you add to that the ECB, the People's Bank of China, the craziness that is going on at the Bank of Japan, and then the lesser fry you throw in there too, Bank of Canada, Bank of England, and the rest of them. The central banks of the world have taken their balance sheet from 2 trillion to 25 trillion in roughly 2 decades, and all of that is one giant fraud, because to buy all those assets, and they bought government debt hand over fist. They bought quasi-government debt like the GSE or Fannie Mae, Freddie Mac securities issued in the U.S. and similar ones issued in Europe and elsewhere. And then on the margin, they even bought junk bonds. The ECB did. The Bank of Switzerland, the Central Bank of Switzerland, owns hundreds of billions of stock. They're one of the largest owners of Apple stock in the whole world. So as they were scooping up assets at this enormous level and intensity, how did they buy it? It wasn't like you or me. We either save some money from our income and we buy some stock, or we own some bonds and decide we want to get a little more out on the risk curve, so we sell the bonds and we buy the stock. That's what the real world does. That's supply and demand. That's a world where there's no free lunch. But in the central bank world, when they went from 2 trillion of assets to 25 trillion of assets, they didn't save a dime. They didn't sell one thing and buy another thing. They didn't tap any deep pool of savings, hiding somewhere in the deep recesses of the planet. They just, made it up. I mean, it was fiat credit. They issued credit to the bond market and the stock market dealers that was made out of thin air. So what we have, therefore, in the world economy underpinning this this 250 trillion of debt is a massively bloated, fraudulent central banking system and balance sheet that made all this possible. But the key point here today is that it is now coming to an end, because finally, even the Keynesians who run these central banks are recognizing that they can't just keep running the printing presses red hot. So, the Fed is actually now pivoted, and this is the big word of the present era of 2019, of where we're going in the financial markets in the future. They have pivoted to QT, quantitative tightening, which means they're beginning to shrink their balance sheets for the first time in the last 20 years. And not only a little bit, the Fed is now dumping 50 billion of its balance sheet a month, which is a 600 billion annual rate. And I think basically very soon the ECB will have to follow suit, or they're going to have a huge foreign exchange and internal inflation problem. And as the ECB follows suit, they already stopped QE. That they were buying bonds hand over fist, but that ended at the end of December 2018. I think later this year they're going to go to QT, and sooner or later that's essentially what the People's Bank of China is doing already. They have to prevent capital flight. So what I'm saying is the whole convoy of central banks around the world are now pivoting to QT. They're beginning to shrink these hideously bloated balance sheets. And there is a law of symmetry that you can't emphasize enough. If on the way up, all this bond buying drove prices up and yields down, if it provided a underpinning for stock market speculation, if it allowed companies to borrow massive amounts of money cheaply and then buy back their stock and boost the stock price, if it did all those things, and we know it did, then when the pivot occurs and in the inverse, the opposite effects are going to happen. Bond prices are going to fall as governments continue to issue new debt, and central banks then pile on and sell down some of their balance sheet. Yields are going to rise. As yields rise, the carry trades are going to be undermined. Corporations are going to find it's not nearly as lucrative to borrow money to buy in stock. And the number one source of stock buying, in the last few years has been the companies themselves buying back, at rates of 600-800 billion a year. So we're now pivoting into reverse for the first time in modern history. The central banks have no idea how they went from 2 trillion to 25 trillion. They just did it a day, a week, a meeting at a time, making it up as they went along. There was no doctrine, there was no received wisdom or doctrine, not monetarist, not Keynesian, not anything, even if we consider it of dubious value. There wasn't any doctrine behind this. They just did it. And once they got that far out in the limb, they were hesitant to slow down or reverse direction. But finally now, that's beginning to happen. And as I say, it's going to change everything. And it means that I think in the next few months, there's going to be a tremendous collision in Washington between the politicians and the central bank, the Fed. If you think the attacks to date have been, quite noisy and unprecedented and spectacular, I think it's going to get far worse, because the borrowing requirements of the Treasury are exploding. I think it's going to be 1.2 trillion this year. And the Fed, despite all of the dovish talk that issued from Powell when he kind of capitulated to the stock market boys and girls who had a hissy fit on Christmas Eve. They have not actually reversed the policy, and I think that's the important thing to recognize. They are still shrinking their balance sheet by $50 billion a month, and that's the driver. Wall Street and the commentary, I call it the commentariat, financial commentariat, is totally focused on the federal funds rate, which has been the traditional Fed lever. But I don't think the federal funds rate amounts to a tinker's dam, if you want to know the truth, because there is no federal funds market left. Bernanke destroyed that 10 or 11 years ago. It's kind of a shocking fact, but about 75% of the volume in the federal funds market is not, from Wall Street or the big banks like Citibank or Bank of America or J.P. Morgan, or even, Wall Street traders and hedge funds. 75% of the volume in the federal funds market is attributed to the Federal Home Loan Banks, which are government agencies that were set up as a parallel to the Federal Reserve System to help the savings and loans and thrifts. Well, that institution, the Federal Home Loan Bank Board and the Federal Home Loan Banks, of which there are 12 of them, should have been, deep six long ago. There's no point. We don't even have a savings and loan industry left or thrift industry. But here these kind of vestigial institutions account for 75% of the volume in the federal funds market. Well, the point is, forget federal funds, forget the targeting of the short-term interest rate. The real action in terms of what the Fed is doing is down in the bond pits, where they are dumping paper at a rate that is astounding compared to history. And let me just throw in one more statistic to kind of demonstrate this. If we go back to, say, about mid-2000, the total balance sheet of the Federal Reserve in that period, July 2000, was about $590 billion. Now, that had taken them, if you remember, roughly 86 years to build a balance sheet to 590 billion from the date that the Fed opened for business in 1914. Now today, the Fed is dumping annually more balance sheet back into the bond pits, 600 billion a year, than the Federal Reserve System had accumulated during the first 86 years of its life. That is going to have an impact.
Wow, what a statistic.
And, notwithstanding all of this kind of squirrely rhetoric you hear from Wall Street, or even from Fed heads who say, well, don't worry about QT. We don't think it's responsible for the volatility that we had in the last part of 2018. Or, we have given plenty of signal to the market that we're doing this, and since the market knows that it's coming, it's all priced in. Well, that's just complete baloney. It's not priced in. When you're draining cash out of the bond pits at 600 billion a year rate, it's going to progressively cause interest rates to respond. Yields are going to go up, and we're going to have a day of reckoning in terms of this whole massive artificial structure of debt that's been created.
Which brings me, this is one of the things, I'm so glad I brought this up. I'm so glad I did this little research on your PDF. It was fascinating. It's extensive. The 37-year bond rally is over, and nobody knows that better than Bill Gross, who had a hard time from 2013 onward, when the thing dived down, quit falling, and it started bottom bouncing. The 37-year bond rally is over, you say in your book. What implications does that mean for America in the future?
Well, I think it has profound implications because we have a whole generation of Wall Street investors and traders and executives who have never known anything except falling bond yields on a secular basis. Now, they kind of jump around a little bit on a weekly or monthly or even quarterly basis. But if you look at the chart, and I remember it well, I sort of bookend the front part of this and Bill Gross the back part, the 37 years. I was there when we were trying to finance a large deficit and national debt of about $1 trillion in 1981.
White House budget director. White House, just so people know, you're the White House budget director in the Reagan administration.
Right. When I was budget director, and yields on the 10-year were hitting 16%, and on the shorter term paper like T-bills and 90-day paper, it was even higher. It was pushing 20%. So if you start from that position and then recognize and look at the curve, and I have a nice chart of it in my book, it's been a downhill ride, which means you could have bought the 10-year bond or the 30-year bond in 1981, gone to sleep for 37 years, done nothing useful that resembles human activity, and you'd be a rich man today because the yields fell and the price of bonds rose year after year. Well, that created a whole mindset that said, there is no danger in borrowing because when we have to refinance ourselves, we never have to pay this debt back. What the economy learned, what people learned, what Wall Street learned, the false lesson of that 37-year run of ever declining yields was that you don't have to worry about getting too leveraged because, one, you'll never have to pay it back. The market is so robust you can refinance. And secondly, when you refinance, your interest rate will be lower, your carry costs will be lower, and it'll be even easier than it is the first time at bat. So that's why, households in America that bottom 80% don't have any savings at all, because they've learned run up the credit card, run up the auto loan, borrow as much as you can against the value of your house, because when the time comes, there'll be a refi market there, and you'll be able to refinance your debt at a lower yield, or certainly not. You don't have to worry about a higher yield. Now, that's 37 years of false signals. That's 37 years of miseducation, and it is. It has been inculcated in the whole warp and woof of not only the financial system narrowly on Wall Street, but of the U.S. economy generally. And what I'm arguing is that we have now reached the end of the road on that 37-year run. And even the central banks recognize that we have to normalize. And even though they're doing it reluctantly and they're dithering and double talking to try to keep the stock market from having the adjustment that it needs, there is no doubt about the direction in which we're going. And that means that business in America, which has 15 trillion of debt today, this is corporations and unincorporated, mom and pop businesses and proprietorships and LLCs and so forth, have 15 trillion of debt. We go back to the year 2000, they only had 6 trillion. Now, what did they do with that huge increase in their debt load? 9 trillion of debt on business and 9 trillion increase just in this century to date. The answer is they use the overwhelming share of it to buy back stock or to pay special dividends or to do leveraged recaps or to engage in massive M&A deals that were funded with debt and that probably didn't add to productivity or efficiency or growth. But since you could borrow the money so cheap, it made the deal, all these trillions of M&A deals, mergers and acquisitions, look accretive in the short run because the carry cost of these inflated assets that all the companies were buying were extremely low. Well, again, that is all going to reverse. The carry cost is going up. Business is, hung now, saddled with 15 trillion of debt. even if interest rates normalized by 1 percentage point, 100 basis points, which is still very low from the current levels by historic standards, the carry cost of corporate or of business in America will rise by 150 billion. In other words, I'll have to pay 150 billion more of interest just for 100 basis points of normalization because their balance sheet is so big. And we could say the same thing for households, which now have 15.5 trillion of debt. And we can say the same thing for the entire economy, the U.S. economy. If we add up both the public and private debt, corporate, household, financial institutions, and governments, it's $70 trillion. And that compares to 53 trillion on the eve of the financial crisis, when everyone said then we were over leveraged and that we were getting some kind of warning that we needed to rectify, our financial ways. But there was no deleveraging in the last 10 years, as I say. We went from 53 trillion, which was excessive, and should have gone down. We've gone to 70 trillion and are just, courting even more danger in the future. So I think another way of saying this is that when the warning came, the heart attack, financial heart attack, as they called it, in September 2008, we didn't actually, the U.S. economy, the Fed, Wall Street, corporate business, households, didn't really digest the warning or the lesson and take appropriate action. They actually doubled down, tripled down, and borrowed even more because debt was made even cheaper than it was on the eve of the crisis. So, in a sense, we've just buried ourselves deeper, and this all relates to my point about Trump, and that is that unfortunately he made his fortune, such as it is. It's debated, he says it's worth 10 billion. I don't know, maybe it's worth 1 billion, maybe it's worth less. It doesn't matter. He spent 35, 40 years borrowing money to speculate in the New York real estate market during this same period in which the central banks and the Fed in particular were fueling the greatest serial sequence of bubbles in modern times. So naturally, Donald Trump thinks debt is a wonderful elixir of economic life and doesn't even remotely recognize the danger that surrounds the U.S. economy, both in the private sector and in the debt that he inherited at the federal level, that he's made infinitely worse by massive increases in defense that we don't need, money he gave to Congress for domestic programs, pork barrel, that we clearly didn't need, but he gave them 65 billion for more domestic pork barrels so that he could get his 82 billion more for defense, a horrible trade-off. And while they were at it, and this was last winter, at the time of the so-called Horribus appropriations bill, they threw in $100 billion for disaster relief from all of last year's 2017's hurricanes and disasters and so forth, and they didn't pay for a dime of it. They just borrowed it. So when you throw all that into the hopper and then you have a massive tax cut that you don't finance with spending cuts or alternative, more benign sources of revenue, you have really created a witch's brew of fiscal calamity. It was bad enough what he inherited, a 700 billion deficit for the current year. I believe he's pushed it all the way, and not just he, Trump, but the Republican Congress has been totally complicit in all of this. They've now pushed it to 1.2 trillion during the current year, and that's how much the Treasury is going to have to borrow in the face of the Fed dumping, as I said before, 600 billion of existing debt. Now, why do I think that's important? Well, because I can do the basic math, and the basic math is if the Treasury has to borrow $1.2 trillion of new money, and the Fed is dumping $600 billion of old borrowings. That means the bond pits out there in the real private sector down on Wall Street have to absorb $1.8 trillion of government debt that's going to be looking for a home. And I think that is going to cause a shock in the bond pits. And, sooner or later, all of that 1.8 trillion will get financed. Somebody will buy it. But I don't think it'll be at the cheap yields that the whole, financial system is predicated upon. So I call that the mother of all yield shocks. And it's kind of baked in the cake. It's coming down the pike. And unfortunately, Trump doesn't get it. So that's another reason why I say we're at peak Trump. We're at peak Trump, one, because the stock market peaked at 2940 back in September last year. I think it has nowhere to go but down, even if we get these dead cat bounces from time to time. We're at peak Trump because he's embraced a geriatric 115-month-old business expansion, the second longest in history, the weakest by far in history. And at the end of an expansion, you always have low unemployment, but the real issue is not the lagging indicator of unemployment, but what's in front of you in the windshield, not what's in the rearview mirror. And we have a recession in front of us. No one's outlawed the business cycle. A recession is going to happen. And all this stuff that he's bragging about in terms of lowest unemployment rate in 40 years and all the rest of it is going to be egg all over his face. It was really a rookie mistake to embrace a big, fat, ugly bubble that he identified correctly during the campaign when the S&P 500 was at 2140. Now, 800 points later, when the bubble was bigger, uglier, and fatter, he suddenly pivoted and embraced it and said it was a vindication of, the Trumpian economics. Well, that was really foolish. And unfortunately, he's now taken ownership of an ugly bubble that he should have been campaigning against from the day he took the oath of office. I point out in my book that he really made a rookie mistake, as I called it, by not using the playbook that Ronald Reagan used so successfully in the early 1980s. And that is, he never stopped campaigning against the failed Jimmy Carter economy. He never stopped telling the public about how bad things were due to policies that had been implemented by the Democrats for years and years until, finally, inflation was crushed by Volcker. We got through a very painful and deep recession, and we came out on the other side. And then it was fair enough to claim better times are coming, better times lie ahead, and to take credit for it. But, Trump didn't wait 2 days before he embraced, a broken economy that he inherited and an egregious bubble in the financial markets that are going to splatter all over, his incumbency anytime in the near future.
What would he already had 20 trillion in debt when he walked into office, and it was all blown up for through Bush and through Obama, so both Democrat and Republican. So they both had to take. What happens if he just bought time? He just said, hey, what's another couple of $1 trillion here and there? I mean, we'll just buy time so I can set the country. And then he's going to take it to bankruptcy, because the point that what you point out in your book so eloquently, so wonderfully, chart after chart, and just wonderful color, beautiful stuff is, man, we're screwed. We ain't paying this money back. So what happens if he just says, okay, I handle the real estate market great in New York, and I handle that well. I also handle bankruptcy great. What do you think that we're headed for, a giant federal bankruptcy, a reorganization of debt? I mean, isn't that really where we're going? A giant federal bankruptcy?
Well, I don't know if it won't be in the bankruptcy court in the 11th sense, but I think you're right in a metaphorical sense. that economically and financially, that's exactly where we are heading.
Yeah.
That, in other words, this economy has been so distorted by ultra low yields that when we start to get back to normal, it's going to cause tremendous dislocation, and it will be painful to try to get from here to there. So, yeah, I think for as far as I can see in the future, the number one, number two, and number three item on the agenda in Washington will be how are we going to finance this debt? Because as I show in my book, you now have built in a run rate of annual deficits that are 1 trillion to 1.5 trillion a year. And if you throw a recession on top of that sometime in the next 4 or 5 years, they'll go to 2 trillion. And therefore, in the decade ahead, we are going to add another 20 trillion to the national debt. The math is very simple. Trump started with 20 trillion, and he's basically adopted policies that will guarantee another 20 trillion over the next 10 years if they're not reversed. Now, I don't think the math of that is all so hard. 40 trillion of public debt, federal debt, on an economy that is struggling to grow, and that's really where we are. The growth rate over time is, a third of what it was historically, is a combination, one, that we've never seen before in history, and second, that there's no magic way out of. So I call it a fiscal doomsday machine, the 40 trillion that's built in, baked in the cake, and an economy that's got so much debt on it that it can't grow, and a population that's getting older by the day because the baby boom, was born a long time ago and nobody can stop the clock. So, there's 10,000 people retiring every day, and the rolls for Social Security and Medicare and the rest of the welfare state, as I call it, are going to go from 55 million at present to about 80 million sometime around 2030, and ultimately to 100 million. That is going to cause the welfare state to explode. We haven't talked about the warfare state today, but that's another $1 trillion a year. We've got national debt and interest that is going to soar into the trillions. And no matter how you cut the math, if you're spending $1 trillion on interest, if you're spending $1 trillion on the warfare state, and if you're spending $3.5 trillion on the welfare state, you have almost nothing else left for all the other functions of government, from highways to education and all the rest of it. So we have worked ourselves into a massive fiscal crisis, and it's going to be very hard to wiggle out of it without some kind of rather traumatic day of reckoning. It won't be Chapter 11. There's no court we can go to file bankruptcy for Uncle Sam, but it'll be the economic and functional equivalent thereof.
Great stuff. You're not really a big gold guy, but you, in the last few interviews, have been talking about, you really need to have some gold. And lo and behold, gold is kind of catching a bid. It's over $1,300 an ounce now. But right. You actually told people that you should have some silver, gold. You should have some because it might be they can't print it. Are you still in that on that camp? Just long term, you should have something other than paper.
Yes, absolutely. Because the essential attribute of gold is that it's a contra central bank asset. It's the one asset that can't be influenced, manipulated, created, or destroyed, for that matter, by the central banks as they alternate from QE to QT and all the other, misbegotten programs and policies they come up with. Gold, was created by the evolutionary processes. There is geologic processes, I should say. There's a limited supply on the planet. It's expensive to mine. and therefore it is the one asset that I think his history has proven beyond a doubt that can retain its value regardless of the mayhem and financial disorder caused by government. So if you buy my general view that central banking Keynesian style is heading for the showers, its day is over, it blew its wad, so to speak, then gold is the place to be. It's the alternative asset to a bubble-ridden financial system that is driven by the central banks.
You also have David Stockman's Contra Corner. That's a subscription service. Tell me about that. You have a subscription service, David Stockman's Contra Corner. I'll put that in after the interview section. So you write a lot. You write weekly, and is any of that stuff free, or is it you have to get a subscription?
Yeah, basically it's a daily, actually.
Oh, daily.
And kind of, yes. It comes out every day. We tend to post about 1,000 words, 2,000 words on any topic that's salient at the moment that relates to central banks, to Wall Street, to Washington, to the fiscal situation, but also the warfare state, foreign policy, the American empire, what we're doing in Syria, Venezuela, the trade war with China, it's the reasons and the red Ponzi in China, as I call it. We talk about all these things on kind of a current event basis, but in the context of a longer term foundation of free market views, fiscal rectitude, sound money, the things that used to be taken for granted when I started working on Capitol Hill in 1970. So that is a subscription service, and it comes out daily.
Wow. Okay. And that's David Stockman's Contra Corner. I'll have the links up for that. You can send them to me if you like, whatever you like, in your subscription page. Also, the book, it's not out in hardback book cover yet, but it is. You can buy it in the ebook in Peak Trump. You'll send me whatever links you want me to use for that, wherever you want people to go, Amazon or to your David Stockman's Contra Corner or whatever. But this is the book Peak Trump. It is, and the PDF, it's 640 some odd pages. It's a huge. You get your money's worth. But anyway,
Greg, let me just add on that
okay.
The hardback version is in the printer right now.
Yeah.
It's available on Amazon to pre-order. So if you like to read printed books as opposed to ebooks, you can order it and it'll be delivered within a week or so.
Your books are, when you buy one of your books, you get your money's worth because you're not lazy. That's
right. Well, they're easier to carry on your computer.
Yeah. But, sure.
The thing is, the book is divided into sections that deal with totally different topics. Foreign policy, domestic, why we've reached peak Trump, all the issues we've been talking about. So there's a lot of pages there, but it's on a variety of topics, which may or may not be of interest to everybody. So it's easy to pick and choose.
Yeah, and all the links will be after the interview section. Again, former White House budget director and the Reagan administration, best-selling author. The new book, you can the hard copy is going to be out. You can pre-order it right now. You can also get the e-copy. Peak Trump is the book. The man is David Stockman. Thank you for joining us today on USAWatchdog.com.
Happy to be with you.